are going to be discussing fake order flow in this video. In other words, low probability order flow. Now with that, we are also going to go over a little bit of high probability order flow and where we can find it. Now, in this video right here, number 1, institutions. Number 2, fake order flow right there. Number 3, within liquidity. And number 4, we're going to end this video with homework. Then, institutions. We understand that order flow is created, or those are essentially the signs, the footsteps that the institutions leave behind when they are involved in the market. They can't hide those big orders that they have in the market that will leave behind a fair value gap. Now, not everyone in the world and in the trading industry understands what a fair value gap is, let alone an order flow lag. But you don't necessarily need to understand what an order flow lag is to see that its intention. A fair value gap is a rapid movement towards one side of the market, a fast movement. But you don't necessarily need to understand that it's a fair value gap to see that it's fast, right? It's just a fast movement up or down. It's an expansion candle, for example. So order flow shows intention. It tells us if we are going to continue higher or continue lower by following the footsteps of those big orders by the institutions as well. But when we then create order flow, when we have order flow and we understand that it shows us the intention, that of course can also be used against people. Now, I want to emphasize on the fact again, it's not necessarily that everyone knows what order flow is. So it's just fast price movements, essentially. That's what fair value gaps are also about. So those order flow lags, those fake order flow lags, what we'll see is fast price movements towards the other side to trick people into the market. Why is this? Well, let's say the market is going higher and institutions are buying and they're trying to reach their next higher time frame level to offload those positions. So essentially sell their buy position and someone else needs to buy that buy position from them. So they need opposing liquidity, but in order to reach it, they also need enough strength, enough buying pressure to actually reach that level in the first place. Now I'll show an example of this in a little bit, but if price is struggling to reach that high, then what do they need? They need liquidity. And how can they generate more liquidity? So how can they add more buying pressure to the overall market? Well, by enticing people with a fake order flow lag to potentially continue lower instead. Again, like I mentioned, 9 out of 10 people won't understand that we're actually looking at a fake order flow lag right there. But 9 out of 10 people will understand that it's fast price action and the price might want to continue lower because that's a human nature. If we think price is moving higher fast, well, then we believe it might want to continue higher as well. But it should be in alignment with the overall higher time frame objective. So let's show an example of this. Here we are on silver and we are currently on the monthly time frame. And here we are as well on silver, but we are now on the weekly time frame right here. Now, overall, what we can see, very simply said, we have just been continuing higher. So we have just been going higher. Now we have swept this low right here, and we have been continuing higher towards this main target right there, that liquidity level. Now, when institutions start buying at this level right here, and we start to continue higher, seeing through order flow lags as well to continue higher right here, then eventually they will look at this high right here to offload those positions. So the buy positions they are in right there, their take profit is of course a sell order. So someone else needs to be willing to buy above that high in order for the institutions to offload those buy positions right there. Now, once we get very close towards the high right here, what actually happens? All of a sudden, we see this bearish order flow lag right there. Now, this is also similar to what we touched on in the previous video, where if you're essentially blind to what's happening on the higher time frame, what's happening with market structure, etc., and you're just following those order flow lags, you might think, well, time to go lower right there. Time to sell, go all in right there, and simply wait for price to continue lower. But this is exactly what they would love for you to think. Now, once institutions, etc., also see this sell-off right there, or other hedge funds that are a little bit smaller, not necessarily moving the market, then this right here, this selling is a lot of selling right there to add new buy pressure to the overall market right here. Because imagine institutions. The market is going higher, everyone is buying right there. So when everyone is buying, there really is only one other thing to do. When everyone is buying, they can only sell. So when we reach here and we don't have enough buy pressure to reach that high right there, perfect. We can add sells right there at the market because everyone is buying in the first place because it has been going higher. Now, a lot of sells enter the market right here. Even buy positions right there get taken out because their stop loss, etc. gets hit. Opening enough new buy positions right there, new buying pressure to continue higher towards this high right there, where they can then offload those positions again. Now, this is what we then call fake order flow, essentially, because that intention and the understanding of that intention can also be used against us. But that depends on the higher time frame levels and the higher time frame objective. Something we've also touched on briefly in the previous video. So when we need liquidity, we can assume that they are faking order flow. And when we see a fake order flow lag, we can also assume they need liquidity until proven otherwise. So let's move on right here and let's understand fake order flow and essentially a checklist that we want to go over. Okay, first of all, what is the higher time frame objective? So what is market structure doing? Are we still continuing higher overall? Is it drawing liquidity towards the highs or towards the lows overall? That's important to understand. Now, the way we determine that is simply look at the higher time frame. Are we going higher or are we going lower? So the example we just had on silver, does that bearish order flow lag out of nowhere make sense? No, because it was not in alignment with the overall higher time frame objective. We were all that time, we were still bullish, so still continuing higher. So if the higher time frame objective is not clear, then I want you to understand you shouldn't even be trading in the first place. Now, not that you don't have the skills to trade. No, you have the skills, but that's just a sign that it's not a clear drawn liquidity. There's no clear direction in the market. So that market is low probability in the first place. So you shouldn't be trading it. So you should focus either on another market, or if you're a flow trader, you should simply wait until it does clear up again. Now, if the higher time frame objective is very clear, then what you want to do is wait for order flow to align again with the higher time frame objective to then continue higher or continue lower again, depending on the higher time frame objective. Similar to what we discussed in the previous video as well. Now, what we also want to focus on is what is the next higher time frame level. So we understood, okay, on silver, the higher time frame objective is still to continue higher. Now, what overall is that next higher time frame level that price is actually aiming for? That's important. So taking a look right here on the dollar itself, and if we take a look at the weekly fair value gap first, we have this weekly fair value gap. That's the first higher time frame level that we trade back into. To then the next higher time frame level that we can reach is this low right there. Like we discussed as well, that context areas, those context areas is where order flow right there on the lower time frame will as well hold. So if we do want to continue higher, we will reach this low and we will sweep that low to then continue higher as well. Now right here, if we then go into the daily time frame right here and we see all of a sudden a bullish order flow lag right here. Can we now continue higher from this? Well, no, because what is the higher time frame objective? Well, don't get me wrong. I say no. Could we continue higher from that? Yes, but it is a no unless price proves us wrong. So what I mean by that is unless we start to respect this order flow lag, create a new order flow lag to continue higher right there, we are proven wrong and we could in fact continue higher right there. But when it's just one order flow lag right here within the bearish higher time frame objective right there, then no, we can more than likely just continue lower overall. Now there's a general rule of thumb that we want to apply. And the general rule of thumb is the following. If you just use this general rule of thumb, then you'll be in alignment with the trend 9 out of 10 times. So the first assumption should be a fake order flow lag is just a retracement on the higher time frame to just continue higher or continue lower. Now a good example of this is on the indices again. Because what we're seeing right here on the weekly time frame on the S is an order flow lag, quite aggressive order flow lag to potentially continue lower. But this is essentially just a retracement right there on the monthly time frame to then continue higher. Now, how does this actually work as well? I want you to understand that every single time frame is going to create fake tops and fake bottoms before we create real tops and real bottoms as well in the market. Now we'll touch on this in a separate video. But the 1 minute time frame will do something like this. It will create bearish order flow lags right here, whilst on the 5 minute time frame, that looks something like this. A bullish order flow lag and a retracement to simply continue higher. So this bearish order flow lags that we see right there on the 1 minute is a simple retracement right here that we see on the 5 minute. Now apply different time frames. So let's say this is the weekly. Let's say this is the daily time frame. And let's say this is the monthly time frame right here. If you say this is the 50 minute, this is the 1 hour right there, and this is the daily time frame again, then you need to understand that some of those retracements are simple, or some of those real tops that might look like real tops in the market right there are simply fake tops because it's just a retracement on the time frame above. Now, once something like this right here starts happening on the monthly time frame, then we're talking about real tops and real bottoms. Until that moment, your first assumption should be, when we create a retracement, is that it is indeed a retracement to simply continue higher. So we want to look for order flow to align bullish again. Then the next thing that we want to focus on is we ideally want to trade within liquidity. Now, this is quite an easy way to understand where high probability order flow is and where low probability order flow is. Within liquidity, I'm essentially aiming at within those higher time frame levels. Now, in other words, what we use is this is within a context area. We always want to trade within a context area that is within liquidity, and that means that it's also within higher time frame levels as well. It looks something like the following. Here we have this bearish order flow lag right there. Now let's assume that it's a good order flow lag right there to potentially continue lower. Then we have this fair value gap sitting right there. Then we can continue lower from that, or the fair value area. And then the context area will be this area right there. This is good. Even if we continue higher at this moment in time, this is good because now we're within this high at the top right there and within this low. We are on internal order flow, an internal order flow lag. Essentially, we are within an order flow lag, a previous order flow lag. That's good. That's what we want to focus on. Now, right here, once we then continue lower, this is exactly that continuation lower is what we can be a part of on the lower time frame. That's where we can capitalize on the lower time frame order flow. It's in alignment with the overall higher time frame trading within liquidity within that context area. Once we have reached a low, I like to call that, and you might notice in the forecast or in a live session, I like to call it, it's in the middle of nowhere, because that's no man's land. When we are not within highs and lows, we are now in no man's land, where we can potentially continue higher, we can still continue lower, depending on if we run or sweep that low. Because again, the understanding of those institutions right there is the following. They add sell pressure right there to the market to reach that low. Now they can either decide the market will continue lower and we will make profit, more profit from those sell positions, or they might think, well, I think we won't make any more profit from those sell positions, so let's offload them, and below that low, they will add buying pressure to then continue higher. So those lows and those highs are important. Those context areas, once they are taken, you want to take a huge step back again, because we are not too certain on what institutions want to do at that moment. Do they want to continue higher or continue lower? Which will eventually be told by, is it a run or is it a sweep of liquidity as well? So right here, if we then move on, because this can also be understood. This was an order flow example, market structure example. From a candle science perspective, this looks something like this, where we have a bearish candle right there. And this is something you will see a lot in a third candle when we are about to create a higher time frame fair value gap the next week or the next month, even the daily as well, where the low that we have right there, the previous candle low, is still something what we can target. So now we are still within that liquidity right there. So this here is a good area to trade. Now, once we reach those lows, you want to be careful right there, because this again is in no man's land. Now, this previous candle low can be used as a retracement to trade back into the fair value gap. Because again, it's a liquidity point. It's where if institutions want to offload positions or they want to create a retracement, then that low is used to create that retracement to essentially continue higher for a little while as well. So we are not 100% certain what will happen above those highs and below those lows. So that is very important. Start practicing noticing those areas within liquidity, those context areas. This is something that we'll touch on a little bit more in depth as well, but I just wanted to introduce you to the concept right here. Okay, then the homework. Spot fake order flow right there. So start noticing fake order flow or do case studies around it, and also spot within liquidity. So understanding those context areas. And when we take those liquidity areas, understand what happens on a deeper level right there, because we're not too certain if they want to offload positions, create a retracement. That's no man's land. Start doing case studies around that as well. All right, perfect. Thank you. All right, we are going to be discussing fake order flow in this video. In other words, low probability order flow. Now, with that,